Markets are laser focused on the AI build-out, but we see other forces at work as well. Geopolitical fragmentation has Japan and Europe ramping up fiscal spending, creating new return drivers. In Japan, we are overweight equities. Return on equity has steadily risen, narrowing the gap with the US and Europe. And this is not just a sugar rush from fiscal expansion. It's a slow burn. It's a structural shift. A focus on capital discipline and shareholder returns is lifting profitability. Japanese companies also have less cross-shareholdings, which makes Japan more attractive to foreign investors. These improvements come against a backdrop of strong nominal growth and rising wages. The end of deflation has enabled firms to raise prices without losing demand. And the Liberal Democratic Party's historical electoral win provides political continuity and paves the way for more fiscal spending on national security. An example of geopolitical fragmentation, a megaforce which is also at play. In Europe, by contrast, we think overall return on equity will need to improve via productivity gains, not just one-off cyclical boosts. As a result, we're focused on select sectors. We favor sectors that benefit from increased defense, infrastructure and energy spending. We also like pharma. It enjoys solid earnings, low valuations, and there are growth opportunities via AI innovation and efficiencies. Financials are another topic. Europeans are big savers and policymakers are making it easier for households to invest and for companies to raise capital, including to the European Savings and Investment Union. We see undervalued European financials in a prime position to channel savings into productive investments. But all this fiscal expansion does not come for free in bond markets. As governments raise spending, investors are scrutinizing debt sustainability and demand more compensation for holding long-duration paper. And that shows up. It's pressure on long-end bond yields, most visible in Japan, but also elsewhere. Higher issuance and stickier inflation can keep long rates elevated. That keeps us underweight government bonds, particularly at the long end, relative to equities. Fiscal expansion tied to geopolitical fragmentation is creating return drivers outside of AI. We prefer Japanese equities over government bonds, and in Europe we focus on sectors that benefit from fiscal stimulus and sectors where profitability and growth isn't priced in, like pharma and financials.